The Federal Reserve meeting minutes were released and they shed some light on the ongoing repo crisis and the inevitable failure of the financial system. Clearly, the Fed is saying one thing and actively doing another. By printing excessive amounts of money every single month in various forms through various methods, they are engaging in a policy that is to provide much needed stability to a very weak system. Sure, they'll never admit that, but for those who are paying attention, we know exactly what's going on. You came here for the truth, so let me unveil that for you. Today we're going to focus on what's happening with the Federal Reserve, of course one of my favorite topics and yours as well. We're going to look at what happened in the meeting minutes, going to give you all the insight there. I'm going to show you what's going on with the Fed rates themselves. We're going to look at the global liquidity. We're going to talk about what's happening in the financial industry. I have some things to cover at the end here as well. Let's begin. Right now, the Fed funds rate is sitting at 1.83%, and this information comes as of November 1st. We see it fluctuating all the time, but the general trend has been that they are decreasing interest rates. They claim December we will not see a rate cut. Now, that could very well be the case, of course, but I just want to show you this to lead into the video. You know, we look all the time at what they are up to. We want to know what they had to say, how many times they said a particular word. We want to know, did they scratch their nose or did it touch their head? Every little detail, even if it's completely not important at all, is seen as though this is the holy grail. This is it. We need to focus specifically on this and trade on this information. The algorithms are going crazy and so on. Meanwhile, there are some fundamentals here that people need to pay attention to, and usually we have to read between the lines. So this document here is actually from the FOMC meeting on October 29th and 30th. The Federal Reserve decides to cut rates. We know what they did in this case here, but in the meeting minutes, we get a little more insight as to what they were thinking. I'm sure you heard a lot about it in the news. I'm not going to cover the basics, but I wanted to show you something that did not get enough attention. In the top right corner, I'll touch on this particular point. A standing fixed rate repo facility would likely provide substantial assurance of control over the federal funds rate, but use of the facility could become stigmatized, particularly if the rate was set at a relatively high level. Conversely, a standing facility with a rate set at a relatively low level could result in a larger and more frequent repo operations than would be appropriate, and by effectively standing ready to provide a form of liquidity on an as-needed basis, such a facility could increase the risk that some institutions may take on an undesirably high amount of liquidity risk. When they're there to provide the liquidity, that crutch, that safety net, this creates a moral hazard. Hey, if I screw up, the Fed's gonna bail me out. I don't need to worry about it. Big problems, of course, as we saw during the financial crisis. Then we had the whole Occupy Wall Street movement that lasted a couple weeks. People got bored, they went home. They brought it up in Congress a few times. They did this and that, and ultimately today, everything is actually worse. When you really look at it, the details show you how bad things are in the financial system. Of course, the stress tests aren't going to show that. Of course, we're not going to see that coming out of the mouthpieces, the suits and ties, and all the garbage from these meeting minutes that we get. But this thing here is so important. I don't think a lot of people understood what it was. Now, we're already seeing daily intervention by the Federal Reserve, but they want to go one step further. They want to provide that drip every day, all day, okay? We are talking about something that would be unprecedented, and I can't believe that they're suggesting it, they're talking about it, so eventually they're going to implement it. It's only a matter of time. Now, maybe they'll wait for the crisis to hit, and then they will stand in and they'll say, well, you know what? We'll be there day in, day out, inside and outside. You don't have to worry about it. Okay, we're going to start buying equities now. Okay, we're going to start buying the bonds. We're going to go crazy on it. Don't worry, we'll take care of you. I don't know exactly what's going to happen, but they've been highlighting some of the issues here, and I think it's important we pay attention. Now, if you remember, they had an emergency meeting. I covered this on a video on October 4th where they all got together and they said, okay, what are we gonna do? They actually highlighted here right on their website as well. Video conferencing meeting of October 4th, 2019. The committee met to review developments in money markets and to discuss steps the committee could take to facilitate efficient and effective implementation of monetary policy. So they had already been doing the repo operations, and of course they knew that this wasn't going to be resolved in a couple days. The staff reviewed recent developments in money markets and the effect of the desk's continued offering of overnight and term repo operations. Staff analysis and market commentary suggested that many factors contributed to the funding stresses that emerged in mid-September. What are they saying here? Oh, it wasn't just one thing. We didn't have one problem. It was everything put together. So we can't pinpoint it, we can't fix it, and so be prepared for more volatility. In particular, financial institutions' internal risk limits and balance sheet costs may have slowed the distribution of liquidity across the system at a time when the reserves had dropped sharply and the treasury issuance was elevated. You know what's funny is all of a sudden they need these massive reserves to be in place. They need a constant injection of money into the system when before the financial crisis they didn't need that at all. Does anybody find that weird? The fact that the balance sheet couldn't even go below $4 trillion without it being a problem. What about the fact that interest rates going above 2% was incredibly high? That was restrictive. That was a problem. I mean, it's a joke the way that they put this in our face. And they also mentioned something I thought was very important to note. Further out, the April 2020 tax season with associated reductions in reserves around that time was viewed as another point at which money market pressures could emerge. There is more information related to this here, but I just wanted to mention it specifically because they are already talking about it. People in the Federal Reserve are mentioning this as another potential moment of crisis, a tipping point, the linchpin. Anything could really take out this market at any time, and they need to be prepared. They need to be there when the market can't naturally be there on its own. So there are two moments that I've highlighted and which are really key. That is year end. They've talked about this multiple times. We've heard analysts talking about this as well. And then we have April 2020. I'm interested to see exactly what happens as we lead into the end of 2020. That will give us some insight for April as well. And I want to see what they do, how they handle it, and of course, how the market reacts. This is a Bloomberg article, and I just wanted to mention a couple points here. It's related to those Fed meeting minutes. Couple things. Officials also considered modestly sized, relatively frequent repo operations designed to provide a high degree of readiness should the need for larger operations arise. You know what's going to happen in the future. You know exactly what's going to occur. This is the tip of the iceberg, my goodness. Third paragraph, Fed policymakers reiterated at the last meeting that they would keep up Treasury bill purchases into the second quarter. And of course, they're talking about 2020. This right here is huge because we will see it go way past 2020. As always, we know exactly what happens. Oh, it's just going to be a couple of days. Oh, it's only going to be until October 10th. Then it was October 11th. Then it was into November. Then it was the New Year. I mean, my goodness, how many times do I have to say this exact same thing? They always use the word temporary when they're talking about repo operations, and my goodness, it is nothing of the sort. Further down in that article, negative rates. Central bankers used part of their meeting to discuss an ongoing review of their policy, strategy, and tools, including an examination of negative interest rates, which have been used in Japan and Europe, but were shunned by the Fed during the financial crisis. Well, if you look at the shadow Fed funds rate, which is essentially when you factor in the amount of money that they've printed, how that is almost, in a way, having an impact on interest rates, the Fed funds rate fell to minus 3%. Okay, so not directly, it was basically at 0%, but factoring in the amount of money printed, it had the effect of being at a minus 3. That's not a good thing, okay, because that is the level of stimulation that they required just to keep the market alive, just to keep the financial system alive. All participants judged that negative interest rates currently did not appear to be an attractive monetary policy tool in the United States. There was a list of shortcomings with the strategy, including the evidence being mixed on their benefits and potential adverse effects on U.S. financial stability. I actually do agree with this. However, in the next financial crisis, when they're already doing the repos, when they are injecting money every single day into the stock market, into the bond market, into the mortgage-backed securities, and whatever else they decide to do, when interest rates have hit rock bottom, what else are they going to do? This is just an ongoing chart here showing you the overnight repo operations. Clearly, every single day, there has been a requirement for the Federal Reserve to be there. That doesn't seem to be changing anytime soon. Now, the December meeting odds, well, you can see for yourself. Probability of no change is that blue line, 97.2%. Overwhelmingly, the market has completely changed its perception of what they believe is happening with interest rates. If you asked the exact same question a few months ago, the numbers look completely different. Now today, everything's totally fine. Why? Because the stock market is at an all-time high. Suddenly, well, we don't care about interest rates. Things change really fast. Now, this article here out of CNBC is basically talking about how there's dissent and how some of these Fed presidents don't agree with the others. We shouldn't cut interest rates, leave things the way they are. And they talk about how there's always this struggle back and forth. They even bring it up with Powell when they do the question and answer. And he says this is very good because it shows us that we have different opinions and so on. They try to make it seem as though all of this isn't pre-decided and predetermined. The Federal Reserve, just like all central banks around the world, are giving out that cheap money. There is no dissent. There is no individuals that are going in the other direction. They were at just over 2%. I can't believe we're having this discussion, but it seems to be the case over and over and over again. Now, I thought this was interesting. This is something that I haven't really touched on recently. We saw the yield curve inversion, we saw it steepen, and now it is going back to the inversion again. This happens to be the 3-month 10-year, which is extremely important historically. There have been cases in history where you see it going up and down and so on. It's not necessarily the first time. I want to see if this does in fact invert again. Now, with the Federal Reserve intervening in the markets the way they are, they have clearly distorted this signal. But let it be known that in all previous cases, they have always been intervening. Yes, this is the most they've ever done, but certainly the central banks are always actively engaging in open market operations and other strategies in order to move interest rates and other factors. One of the most important things here is to look at the global liquidity and see it in comparison to the stock market. This happens to be the MSCI World versus global liquidity. You have to see this as regularly as you possibly can. These two charts are completely correlated. We're looking at it basically from the beginning of the year up until the present, and it shows you how important the money supply is for those who pay attention to stocks, to those who are invested in stocks. Instead, they talk about, well, look how fantastic this company's earnings are. Look at the unemployment rate. Look at this factor and this indicator and that measure. And my goodness, if you only looked at one, this is what you need to know. And to finish the video off, Deutsche Bank says robots are already replacing workers as it ramps up a plan to axe 18,000 jobs. Isn't it interesting they're going in this direction? Just like all of the other financial companies with robo-advisors, they're using AI, they're finding ways to quote-unquote increase productivity. So far, 680,000 hours of manual work has already been saved. This is the way that they are selling this to their shareholders. Meanwhile, the stock is down over 90% from its peak from the last time I saw it. Clearly, we've got a very big problem going on at Deutsche Bank, but this is with all of these financial companies. And when you look at it deeper, as we have done so many times on this channel before, everything is failing. Without the Federal Reserve and its unprecedented level of support, it's simply going to be a catastrophe. That's all for this video. If you found it informative, hit that thumbs up button. When you hit the like button, you are supporting me, so I do appreciate that very much. If you want to learn about passive income, if you want to learn how to build a business online in your spare time, this is a free e-course that I created for my subscribers. You can check it out at theamazongps.com. The financial system is convoluted, it's filled with jargon, it's always there to confuse you, but I wrote these 2 books that make it super simple. Just like my videos, I remove all the jargon, I give you what you need to know, I leave out that which you don't. Check them out at the link in the description. If you want the audiobook, that's at themoneygps.com. If you want to know what's really going down, this video is really important, and sadly not enough people have watched it yet, so definitely click on it and I'll see you there.